You're looking good, Lola. Are you outside? That looks so fantastic.
You're muted, Lola.
No, I'm just by the sliding glass door, but I've been outside.
That's wonderful.
Good to see
forward to that
everybody.
time. Yeah, it's good to see everybody. Mhm.
Well, it looks like on the meeting invite that BTC is not on the list of people invited. So I guess they won't be presenting because I don't see them on the list of of people included. I think they had planned.
Yeah, I was going to say it would have been interesting to hear their take on what's going on, but of course, nobody has any take probably yet.
Yeah, and it probably lags a little behind.
Yeah.
You know, they would be reporting on reports.
Correct.
Previous, yeah.
That would have been year-end reports. So they don't have end of first quarter yet anyway. So as far as first quarter, we'll have them present them.
And John just logged on.
Oh,
yeah, I was
good.
gonna say he's
Oh, good.
on, and then they were notified by email as well.
Okay, thank you. I didn't see them on the list when I pulled up people, so I apologize, Rosie.
That's okay. Sometimes
you're
it
good at
doesn't
that.
show up. It's weird.
Okay, so John and Ellen are on. Good. So we will start with them, and then following John and Ellen will have a discussion about our investment policy that we've been discussing and the actuarial review and where we're at on that, and have some direction on that. And then that's pretty much all I have on the agenda. So with that, John and Alan, take it away.
All right. Can everybody hear me? All right.
Yeah.
I'll go ahead and share. And hello, everybody. It's good to see everybody again. Feels like it's been a while, and I guess it probably has. It's been a few months. So hopefully everybody's good and happy, and we're past February, which is great. Although it did snow heavily last Wednesday. Can you believe it? Okay. We'll go right to, let me see here. Every year, we do an investment policy statement review, and this is common across all of our client base. It's appropriate as a committee, as an investment advisor, to review with you the points of the investment policy statement, which governs what we do in managing the portfolio. And so, can you see this all right? Is it big enough? Okay, perfect.
Yep, looks good.
Okay.
Yeah.
So these are just the highlights. It's not everything in the IPS, which is many pages, the highlights. And we're just going to go through these, and then we'll proceed to the investment report and hit the highlights there. So for starters, the investment goals, as they're stated in the investment policy statement, the key goals here: serve the best interests of the active and retired members. So that's a theme that we talk about from time to time, and it comes up in these meetings. It's serving both parties. And both parties have different time horizons, which is a key point. You know, the active members, they have a longer time horizon. They have a lot longer to go till mature or to retirement. And so the asset allocation has to accompany retired members. They're in retirement. And so the asset allocation also has to accommodate them. So that's why we don't have 100% equity or 80% equity, because that would not be appropriate for retired members. Although for active members in their 20s, it might be. So the asset allocation kind of needs to be a one size fits all, and it is. Second key point: meet or exceed the benefit funding requirement and produce a reasonable return. So benefit funding requirement, that's determined, you know, it's some of the work that actuaries do. Produce a reasonable return. That's what we're in the business of doing. Reasonable return, well, what does that mean? Among other things, it means, or it is the reason behind what I just mentioned, also active and retired members. We're tasked with producing not only income for the benefit of all members, active and retired, but also producing some growth in the portfolio, which will benefit all members, but it particularly benefits the active members. We want to make a return that at least exceeds, and ideally far exceeds the rate of inflation, for example. So that's why we have equities in the portfolio, because almost all the time, especially on a long enough time period, 12 months or more, equities, the growth in equities exceeds the rate of inflation, and it has in the recent period of inflation. So good things there. That's why we have a blended asset allocation. And I know we talk about that asset allocation quite a bit. It's an appropriate topic, and we'll continue to talk about that perhaps today. And then the third point, allow for adequate liquidity and have a risk level that is prudent and reasonable. So adequate liquidity means, for example, right now, per month, the distributions to members is about 1.3 million. So we need to make sure, and we do make sure, that we have adequate liquidity to make that payment. We don't want to have to sell investment assets at losses. So the investment team very carefully manages the portfolio to have that much in cash or liquid assets, very liquid assets every month. Example, and then also have a risk level that is prudent and reasonable relative to membership, their time horizon, for example. We've got active members that have a long time horizon. We've got retired members that have a short-term time horizon. So risk level, this gets back to my prior point, which is we've got retired members, and having a 80% equity allocation, for example, would not be appropriate for them. It would be too high risk. Conversely, but we do have some equity because we are acknowledging that we've got active members that are under 60, under 50, under 40, and we want to produce some growth in the portfolio for their benefit over the long term. So risk level that is prudent and reasonable. You don't want to take too little risk because you're missing opportunities, but you also don't want to take too much risk. It's a blend, it's a balance, and that's an aspect of what we do in terms of managing the portfolio. Thoughts or questions on that? Okay, investment considerations, time horizon. It's the membership lifetime, the membership collectively, everybody in the policy. That's the time horizon by which we are managing this. And it drives it's the why is the allocation what it is. It's the key question here. Why is the allocation what it is in this entire portfolio? It is because of the members. It's a blend of many members' or life expectancies. Risk tolerance is moderate. What that means is that we have a blend of, it's not only income, which would be very conservative. It's not only equity, which would be aggressive. It's a blend. Another way of stating it's a blend in our business is calling it moderate. Moderate meaning middle. Liquidity, adequate liquidity for periodic distributions. I already covered that point, but that's a key point as well. Investment in how we manage and why we manage the portfolio the way we do. Eligible investments. A good selection of eligible investments here. So cash and equivalents, money market funds, for example. Money market, I'll leave it at that. You get that. Fixed income, investment grade. We don't hold much, very little. High yield. It's almost all investment grade for safety. And for safety with plenty of yield. Equity, U.S. and foreign equity, a little bit of both. Heavy on the U.S. equity, simply because U.S. equity continues to, except for the last 3 months, U.S. equity has outpaced foreign equity for a couple decades, which is, theory is that there's more growth in foreign equities, but you haven't gotten paid for that. So we've heavily emphasized U.S. equities in this portfolio and likely continue to do so unless we see a stronger trend emerge in foreign equity versus U.S. equity performance. And then it's invested in individual stocks, bonds, and funds. We can use all three of those in any combination to get to the best investment result possible. Other considerations, the plan has a provision for distributing earned income, and that's based on net realized gains and losses, the net of the two gains and losses from the investment activity over the course of the fiscal year, and then also income that's produced by the portfolio. And there's a formula for that that's detailed in the plan document. So I don't detail it here, and it's actually not detailed in the IPS, but it is mentioned, and so I mention it here because it is a key feature of the plan, and it enhances the return that the members receive over their lifetime. So any thoughts or questions on that? Final statement, catch-all statement is that we have reviewed the investment policy statement thoroughly. We review it and use it as it's a living document for us, and we refer to it several times throughout the year as we manage the portfolio. We do not have any recommended changes at this point in time. We will let you know if that ever arises. A good investment policy statement, though, fits and doesn't need many changes over time. So this is very normal that we don't have recommendations, but we will make recommendations if necessary as we move forward. So, all right. Moving on to the report, got that here too. Okay, we'll go right to the compliance page. It's nice that it's convenient, right on the heels of our discussion or our overview of the IPS. So getting into specifics, and this is all as of December 31st, and I'll give you some updated information here too as we go. All as of December 31st, the weights of all of these asset classes is still fairly similar to where we were at the end of the year. You may think, well, gosh, the equity market, if you follow the stock market at all, you know that it's been moving around a little bit. Well, we're about in the portfolio in terms of the weights, we're about where we were at the beginning of the year because the equity market went up to start the year. January, it peaked at an all-time high in mid-February. And then since mid-February, for example, the S&P 500 is down about 10%. It's up a little bit today, I think. I didn't see the close. But it's been down for several days in a row due to concerns about the tariff discussion. And we won't go into that because you're probably all tired of that. And tired of all that and just the political cycle in general. So we won't go into that. But anyway, lo and behold, the S&P 500, for example, is down 4.3% so far this year. So 4.3% in the grand scheme of things is not that much. I'm not trying to diminish the equity market move in the last few weeks at all, but it just goes to show that, or it's relevant to the point here. December 31st weights that you see, we're in a very similar, the weights are very similar now compared to what they were at the end of the year. So cash was right at 5%. It's down lower than that actually now because there have been distributions out of the portfolio. The biggest ones by far are the 1.3% distributions that occur near the beginning of each month. And we just had one of those last week. Fixed income, total weight there, almost 71% at the end of the year. Well within the IPS range minimum maximum guidelines of 60 and 90%. So that looks good. Investment grade, AA and above, 56, almost 57% of the weight. So very high quality portfolio. And Jeff will share some statistics on this as we further into the report. But high quality portfolio, you can tell right there based on that line. Investment grade, another category is BBB, 13%. So that looks good as well within the IPS ranges. Investment grade, none at this point. So that's good. Sometimes we have a little bit of that simply because we don't hold any of that long term, but sometimes if a bond gets downgraded to below investment grade, we may have that for a particular small period of time, but we don't at this point in time by design. And then a little bit of preferred. And there's a sliver it was below investment grade at the end of the year, and that has since been sold. So consistent with bonds where sometimes a bond may get downgraded into below investment grade, we sell that pretty quickly and get out of that. So this 0.1% is no longer there. It's been reinvested in fixed income. Okay, equity at the end of the year was 24.4%, and currently it's about 24.7, I believe, is the weight. So it's moved around a little bit. It's actually up a little bit, but moved around a little bit compared to where it was at the end of the year. And it's well within the guideline of 10 to 30%. We've actually trimmed equities. We trimmed equities in December pretty heavily, and then again in January pretty heavily. Sort of, we don't wait for the market to go down we don't wait for the market to go down. We don't know when the market's going to go up and go down, but oftentimes when the market's up a lot, we trim or sell to capture gains and lock them in. And we did that in December and January. I don't have the exact numbers, but the selling was in the neighborhood of at least a couple million, I think. 2 to 3 million combined in December and January on an allocation of about 35 million. So we sold a decent size position in those equities while we had big gains in them. So that's why it's down a little bit from, in prior periods, only a couple percent under 30%, but we're coming in well below at 24.4% at the end of the year compared to where we've been in other quarter ends. And it's a collection of small cap, large cap, small cap, and real estate, and then also international stock, as you see here. And all of those weights are within the guidelines specified in the investment policy statement. So no rebalancing or anything like that needs to be done. And then also other limitations, investment in any one corporation. I'll point this out because over time, we've held not only the stock of Walmart, for example, but also the bond, and we've been very close to that 2.8% limit. Currently, we have a bond and stock combination that's 1.8%, and we're managing that to keep it under that 2% level. Corporate bonds, they make up 44% of the exposure, and then municipal bonds are 16%. Very little in treasuries or government agency bonds. So Getting a little more yield from corporates than we would from governments, and the same thing with munis, but lesser so than corporates. So corporates continue to be a featured asset class in this allocation. All right. Thoughts or questions on any of that? Everything's in compliance with the IPS, so we're good. But certainly, if anybody has any questions, we'll pause for those. Yeah, moving on to the next page. We've got the asset allocation just summarized in the upper left. So cash and equivalents was almost 8.5 million, or that 5% weight that you saw on the prior page. As of December 31st, it's down from that. It's only a couple million, 2 to 3 million at this point. Fixed income, 122.4 million, 70.5%. All of that combined, as you can see, the two numbers here, fixed income and money market, is almost 75%, or 75.4%, slightly over 75%. And then we've got 24.6% in equities. Most of that's in U.S. equities, 20.6%. So 35.8 million in U.S. equities, and then complemented by the 7 million in foreign equities. Asset allocation has been fairly stable over time, as indicated by the bar chart in the lower left. That navy blue portion of the bar is U.S. equities, and you can see that the size moves around a little bit, but we actually increased it here a little bit in this year when the market was sold. We've sold off some since then as the market has gone up over the last couple of years. But in general, that U.S. equity weight and the weights of the other asset classes shown in gray and green, and then a sliver here in blue for money market weights, are pretty consistent over time, which is what you would expect to see. Okay, next, John and Jeff will talk about performance. So I'll turn it over to them.
Okay, thanks, Alan. Taking a look at the performance on page 4, just at the total fund level to give you an idea of performance for the portfolio, and then relative to a standard industry benchmark. Taking a look at the 3 months, the portfolio was down 1.6%. That's compared to a benchmark of minus 2.3, rounding to the nearest decimal point, 0.1%. For the year to date, up about 6.5% relative to a benchmark of 4.74. So on a relative basis, a good performance year. Absolute basis, almost 6.5%. So a good return there. And you can see going out for the longer term periods, 3, 5, and 10 years, and then since the inception, good performance relative to that benchmark. Coming down one notch to the cash and equivalents, this is your money market fund. So, that's been one of the nice things over the last couple of years as we've seen those interest rates go up. It has allowed a much nicer level of income to be generated from those balances in money market fund. As you can see, for the year, your return was just a little over 5%. So once again, some nice cash flow coming from that, particularly in contrast to those years where money market funds were paying basically just a little above zero for the most part. On the fixed income front, Jeff Beardsley is on the call. Jeff is the head of our fixed income team, and he oversees the fixed income investments for your portfolio. So I'm going to turn it over to him to talk about fixed income performance.
Hopefully you can hear me. If you can't, please signal that you can.
Go ahead, Jeff. Yep.
Okay, great. We're actually outperforming, even though we had a negative number for the last 3 months. That was because during the latter part of 2024, we did see interest rates rise and into early 2025. But we've seen some improvement. If we actually were showing the 2-month numbers year to date, again, we would show outperformance. So this negative number is outperformance. You can see the 1 year to date number for the entire year, 2.91 versus 1.25%. So, and the benchmark that we are using is the U.S. aggregate bond. This is the most common. It used to be called the Lehman Ag, then the Barclays Ag, and now the Bloomberg Ag. So it's gone through many names, but it's the same benchmark that's been used for many, many years for the account. And you can see relatively consistent outperformance. And how do we get that outperformance? We invest in some of the sectors. We invest more heavily in corporates. We invest more heavily in sectors that have done well over time, and we continue to do that. Investments at this point, and we can return more to that when we get to the characteristics page. So I'll turn it over back to John to talk about the equities.
Okay, thanks, Jeff. Yeah, taking a look at the U.S. equities, you can see your return last year was almost exactly 18.5%. For the benchmark, about 19%. So pretty much in line with the benchmark. One of the areas, and I think we've touched on this before, it's been a few years now, we did add a specific category to the equity holdings for real estate investment trusts. And we did that as we were experiencing that very low interest rate period, because REITs, as they're called, real estate investment trusts, typically pay substantial income out to their shareholders. So we added that. But last year, the REITs did not perform well as a group or as a sector. They generated great income, great cash flow, but in terms of an appreciation perspective, they didn't perform really well. That helped pull down that performance a little bit in terms of the overall equities. And then as you see at the bottom there on the page, foreign equities up a little over 5% compared to that benchmark at 3.8. So good relative performance there. As you've seen over the last few years, foreign equities have lagged the domestic markets. So far this year, we've seen a reversal of that. As you can recall from looking at the asset allocation and the policy parameters, we do have ample room if we would want to increase our international equity exposure in the portfolio. We're not to that point yet, because one of the things we've seen the last couple of years is we've had brief periods where the international equities have outperformed domestic. But once again, after that brief period, we went right back to where the domestic equities were providing much superior performance relative to international. So we haven't made that determination yet if this is another one of those short-term periods or whether it's something that may have a little more duration to it. So we're evaluating that. And if we do get to that point, we do have ample room to make that change should we decide to move forward with it. So with that, I'm going to turn it over to Jeff again on page 5 for a discussion of the fixed income characteristics in your portfolio.
Thank you, John. In the portfolio right now, you can see kind of what the yield to maturity and the yield to call and the current yield, kind of what they indicate is what kind of yield are we getting today on what we're purchasing within the portfolio. So what we are buying right now.
Excuse me, Jeff, your video or your audio is kind of choppy and cutting out. I don't know if it is for anybody else.
Hey,
It's it's a little bit rough, Jeff.
Yeah, I'm gonna hold the mic a little bit closer to me. Doesn't mean I need to get closer to the screen. I just need to get closer. How's that?
About the same.
Not a lot better.
Tell you what, how about if I go through this page? Does that work?
Yeah, why don't you go ahead, Alan?
Okay, so Jeff was talking about the yield to maturity and just noting that at 5.1%, almost 5.2%, if you round it up. So nice healthy yield, a lot higher than we've gotten in prior years. That's benefiting the overall yield of the portfolio. Or the overall yield of the portfolio continues to come up as lower yielding bonds mature and we replace them with higher yielding bonds. So this number keeps on kind of creeping up, and we'll see where we go from here. But stay tuned. We'll have we'll give you an updated number in a couple months. Current yield, a little bit different, but in that same 5% neighborhood. So nice healthy yield there. Both of those higher than the aggregate bond index, which is good. That's basically what you're paying for active management, and the investment team is working to produce that higher yield. That's one aspect of what they do, or the value they add. Average quality. The average quality is AA2 for the index, A1 for the portfolio. Both numbers are very high quality, but adjusting that quality in terms of what we're targeting versus the index, that's one way that the team produces that higher yield. Average maturity, we're slightly longer, but it's fairly immaterial difference between 8.6 years and 8.4 years. So really pretty neutral in terms of the average maturity. Effective duration, we're actually a little bit less than that of the index. Not a lot of difference either, but that is one difference that is key to producing a little bit higher yield. And that's something that the team evaluates every time they buy a bond. So this characteristic and what the impact on the yield might be. So bottom line is a couple of different ways that the investment team, particularly the fixed income team, is producing value in this portfolio. Okay. Am I getting some feedback, or is that me, or is that just something in the background and somebody's that, as long as it's not bothering me, as long as it's not bothering any of you. So, okay. In terms of the makeup of the portfolio, there are a variety of different bonds that are purchased, or fixed income instruments that are purchased in this portfolio. The largest allocation, which we pointed out earlier, was corporate bonds at 59%. That's higher than the index. The index has more weight in U.S. Treasuries and U.S. governments. We buy less of that, not very much at all, in fact, in this portfolio, simply because you can get a little bit more yield in these other asset classes, particularly corporates, municipal bonds, and then mortgage-backed securities. So that's what the team does. And again, another lever that the team can use to produce a higher yield than the index. So smaller allocations elsewhere, but mostly, again, concentrations here in corporates and municipals, and then some in MBS. And then finally, just a snapshot here at the bottom showing the distribution of the quality distribution, we would call it. A little bit in AA, those would be the U.S. Treasuries, for example, and some of the others. But AA and single A are where the most weight is. And so the index is concentrated in this AA, which if you actively manage and you can smartly or intelligently buy bonds, you can not only, you don't have to stay in this AA range. You can go into the single A's, which are still very high quality, and add weight there and increase, as I mentioned previously, increase this yield compared to the benchmark. And then finally, an allocation to triple B, reasonable risk, higher yields yet compared to single A or double A. And so that's another way to enhance the yield, is to intelligently manage an allocation to triple B. So that gives you an idea of the quality distribution, similar to the index, taking a little bit more risk, but it's smart risk. So works out to your benefit. And let's go on to equities. John, you want to cover large cap value, John?
Sure, absolutely. So turning to page 6, taking a look at the characteristics and holdings for the large cap value strategy. And you'll recall, this is the strategy we really focused on for several years as we went through that period of very low interest rates. And that was because this strategy generates a meaningful amount of income relative to the broader equity market, a higher level of income. And as you take a look at that information in the upper left-hand corner, you can see the dividend yield, 2.6% versus the MSCI USA Value Index at 2.3, basically. So it's basically 2.7 to 2.3. And as we'll see in a little bit further here, when you're looking at the broader domestic market, it's basically about half of that. So much higher income, in addition to some appreciation potential within the holdings of this portfolio. But a couple of the things we really focus on in this strategy, in addition to that dividend yield, is the price earnings ratio. As you can see, it's a little bit higher than the benchmark, roughly equal. We typically have that lower than the benchmark, but at any moment in time, we could bump up a little bit higher than it, but it's not extremely higher than what you can see for that benchmark in the right-hand column. So just a touch over, but typically you'll see that being lower for the portfolio. And then in terms of the allocation, we did have a heavy allocation to cash at the end of the year. We'd made some changes and had not put that money back to work yet. So at the end of the year, we actually had a higher amount of cash than we typically keep. But in terms of the other sectors, in terms of how the positioning was, in terms of those where we were overweight relative to the benchmark, not a lot because of the cash position. We were just a little under the weight from the financial sector, which, as you can see, is by far the largest sector in this index. When you're looking at the value index, of course, as I mentioned, you're looking at companies that are a little more focused on providing dividend income, and financials fills that bill very well because a lot of bigger mature companies that have the capacity to pay higher dividends, and they do so, and that's why they're so widely represented in the index and the portfolio. So as you look at that lower right corner, you can see some of that borne out because the third largest holding is JP Morgan. The 10th largest holding is Ameriprise Financial. And as you take a look here, because this is a large cap strategy, there's probably a number of names you're pretty familiar with. ExxonMobil, Walmart had a fantastic year last year in terms of its investment performance. Johnson & Johnson, another very mature company, which pays out a very nice dividend yield. So that's just a quick summary of the value strategy. And if you have any questions, I'd be happy to entertain them. But if not, I can move on to the next page.
Quick question, John.
Yes.
So I pointed out earlier that the S&P 500 was down 4.3% year to date. Probably feels like that more than that to a lot of people because of the news cycle. And it is down from its high in mid-February. It's down about 10%. So it does feel, it looks like it feels like. Putting you on the spot a little bit, I know large cap value has outperformed the S&P 500. And that's what we're heavily positioned in here. And from the beginning, large cap value has been a key component of this allocation for that lower volatility, lower risk, higher yield that you just pointed out, 2.66% at the end of the year. So roughly speaking, where are we on large cap value down for the year? Are we down 2-3%? Where are we down? Do you recall?
Not off the top of my head. I can tell you very quickly. But
I'll look it up while you talk. So
okay,
I'm sorry.
It is significantly less than the overall market, and we have, as Alan is alluding to, seen value stocks move to the forefront within the domestic markets in terms of performance. We've had the last several years where, particularly the last couple of years, 2023, 2024, where growth stocks were much, much better performers than value stocks. That focus on, as you've probably heard the term, the Magnificent Seven, which was comprised primarily of technology-oriented issues that had been growing very rapidly. Companies, once again, growing very rapidly, and a lot of investor enthusiasm for those stocks. And value still presented very good returns for last year, but lagged relative to growth. But once again, given the construct of the portfolio and the definition of return, we really want to focus on that income component to a degree. And given how low interest rates were, we really wanted to focus on income in the equity portfolio to support the fixed income portfolio as it went through this period where interest rates were so low. So, Alan, have you got that, or should I go on?
I've got it. Yeah. The value component of the S&P 500 is actually up 0.1% as of the close today, whereas the whole S&P 500, the value and the growth, is down 4.3. So that gives you some sense. And I wanted to point this out. Gives you some sense, and it's a good example of the safety margin that we've built into this portfolio. But you're still getting growth over a long period of time.
Exactly. And we can talk a little bit more about that when we turn to page 7 and take a look at the information there, because this is for what we refer to as our large cap core strategy. And we added this relatively recently because we've seen that increase in interest rates and getting that increased cash flow from the fixed income portfolio, as well as the money market fund. We felt we could incorporate this strategy, which has a lower dividend yield, as you can see in the upper left-hand corner. About 1.2% was the yield as of December 31st, but it does have more growth potential. So we've started to build a little more of a balance between the value and the growth in the portfolio, where we emphasized value extensively for the last couple of years. And now we've kind of moved away a little bit to incorporate a little more growth exposure to the portfolio. So as you take a look at this portfolio, once again, we made some changes towards the end of the year, a little more cash than we typically keep. And as you take a look in those columns, in terms of the sector allocation, you can see information technology as of 12/31 was 32% of the benchmark. We were just a little bit less than that at 29%, because, frankly, some of those things that had appreciated so well had started to give us a little cause for concern in terms of their ability to maintain that. And as Alan just alluded to, that growth component has very much underperformed the value so far this year, where value has had much better performance, actually slightly positive after the up market today, versus the continued down market on the growth side. So once again, we wanted to introduce this component to the portfolio, and we'll continue to evaluate how much or how extensively we want to use it. But we thought, given once again how the fixed income was generating a much better cash flow, much better yield, we could do this comfortably. So when you move over to that top 10 holding list in the lower right corner, you can see those are the big names that had performed so well the last couple of years: Apple, Nvidia, Microsoft, Alphabet, Amazon. Broadcom specifically in the month of December was up hugely. It's another semiconductor company. And then to kind of round it out, we do have, once again, very recognizable names: Exxon, Meta, etc. So good representation to have in the portfolio. And like I said, we'll continually evaluate to what extent we want to emphasize growth versus value or balance those two. And we'll see where we go as the market continues to move forward here in 2025. With that, I'll move to page 8, which looks at the small cap equity strategy. It's not a huge part of the portfolio, but we do think it's an area where there is some potential value. And as you take a look at the portfolio there, in the terms of the characteristics in the upper left-hand corner, you can see the average market capitalization for the stocks in the portfolio is about $6 billion. For the benchmark, it's about $6.4 billion. Contrast that with the core strategy we just looked at, where the average market cap is $1 trillion. So very, very large differential there, as we've seen once again those very large companies move up into some market values that would have been unimaginable just a few years ago. So taking a look at this top 10 holdings, as you look through that list, it's not nearly as familiar as those large cap strategies, but we do have broad diversification, as you can see in the sector allocation across those various economic sectors. And so with that, I'll move to the next strategy, which is the international strategy. This is managed very similar to that core equity strategy, only utilizing stocks of foreign companies. And one of the things I like to remind people, we call this an international strategy. We actually are investing in what are called American Depository Receipts, or more commonly known as ADRs. What these are receipts that are backed by shares of the actual foreign company that trade on the foreign stock exchanges. The advantage of using the ADRs is we can trade them all domestically here in the US on the same exchanges we trade for the domestic strategies. So it takes an element of risk out of the management of this strategy in terms of trading outside the US. By utilizing these ADRs, we keep all that trading here in the US. So taking a look at the portfolio, once again, we do like to see that price to earnings ratio below the benchmark, and you can see it is easily under that as of December 31st. And international equities, for the most part, do pay on average higher dividends than US stocks. And you can see the dividend yield from this portion of the portfolio, 2.8%. That's partly due to the fact that one of the biggest sectors here is the fact that financials, once again, comprise a good chunk of it. So that helps provide a little more dividend income as opposed to the US comparable strategy. And you can see our largest weightings were in that financial sector along with industrials. So once again, the same information, the pie chart, which gives you the allocation breakdown in a visual as opposed to the numerical one on the left, and then the top 10 holdings on the right. And then finally, the real estate component. As I mentioned that earlier, we incorporated this a couple of years ago, once again, to focus primarily on the income generation from these holdings. It's not a huge part of the portfolio, but as you can see in that upper left-hand corner, it's giving you a dividend yield of 6.3%. Think about that relative to the broader US market that we looked at a moment ago, which was about 1.2. So you're about 5 percentage points higher in terms of the income it's generating. Now, last year was not a good total return year for real estate, but the income level, as you can see, is very good. And then on the right-hand side, particularly the lower right corner, you can see once again the top 10 holdings. They represent a variety of different types of real estate investments. So we do have a broad level of diversification within the portfolio. We have 20 holdings. So we're not concentrating in any one particular area of real estate, but we do want to once again focus on that income generation, which, as you can see, is a little over 6% as of December 31st. So with that, I will stop talking and once again open it up to any questions or comments that you may have.
All right. No, we don't know exactly where the market's going to go, and I don't know when the tariff drama is going to end. So the most common questions.
They are, as Alan says, the most common question we get now, understandably, because there's been a lot of volatility that has been around those potential and actual policy decisions and the impact of those. You know, we do see estimates of it in some form, but until we get further into it, we really won't know for sure. We are starting to see some economists ratchet down their expectations for growth this year a little bit. We've actually started to see some slight reductions in the expectations for earnings growth this year. So it'll be interesting to see. And one of the biggest things that's changed over the last few weeks, and if Jeff had a better microphone, he could give you more detail, but you know, we've had a lot of volatility in terms of how many prospective cuts in the Fed fund rate we might see this year. You know, we were at a point where there was an expectation we might see one, we might not see any. As of right now, we're back to 3. Now, they're primarily in the second half of the year. I think the first one, Jeff and I looked at this morning, that's expected is perhaps in May, with the other 2 coming later in the back half of the year. But that's just how much volatility we've seen and what's expected in this case, Fed fund rate reductions. And we're also seeing some tweaking, as I mentioned, of earnings estimates and economic growth estimates. So we're monitoring this very closely. It, like I said, sometimes changes intraday, not just from day to day. So it occupies a lot of our time and energy as we try to evaluate what's going on and how that prospectively impacts client portfolios.
It's a topic we're digging into and spending a lot of time on. And Jeff and John are working on they spent several hours already working on a detailed presentation that they're going to give in Arizona next week. So in our market in Arizona next week. So more to come on this and other topics. And if you have questions or thoughts in the meantime, feel free to route them to us through Kathy. And we'll keep on following the markets and managing the portfolio, and look forward to our next conversation.
I wanted to thank you for pointing out how you have worked to protect our fund and our investment and keep our returns as high as possible, especially with all the uncertainty. I don't know if Barb had something she wanted to ask. I saw her microphone come on and off a couple times. But I also want to make sure that Rosie Rios got the PDF of this slide so she can add them to our board docs agenda. That would be very helpful. But do you have something you want to add, Barb?
I just have a question, in terms of the volatility, how do you manage all this? I mean, do you go day by day to make changes based? How do you make decisions when you don't know?
Well,
I'm just curious.
Sure. No, as we tell all of our clients, we really want to focus on the long term. And the thing that we like to remind clients of is, as disconcerting sometimes as volatility can be and uncomfortable it makes you, how uncomfortable it makes you feel, it also represents opportunities. So for example, we had a company report last week that's held in your core equity strategy, reported its earnings. Market didn't react well to it, but we thought, this is a company we really like. We really think long-term it's going to be a good holding to have in the portfolio. So we added to it, and that has paid off for our clients. So when you have these situations where you have things moving quickly, number one, we do, particularly in the big picture, try to look longer term, but there are opportunities that present themselves that we like to be able to take advantage of, and that increases with the volatility as well.
Okay, great, thank you.
One of the things the team does and related to this portfolio and all our client portfolios is think of the general idea of if global economic growth continues, which is primarily driven by population growth, not completely, but higher consumption globally is driven by a variety of factors, but number one is population growth. So what you get is you get growth not only in equities, but then in companies that are selling products and services. That line continues to slope up like it has for the last 100+ years, really since it's been kept. You keep an eye on that, but the volatility around that line that may continue to get higher. Who knows? Day to day, it's been about as unpredictable as it gets over the last 6 to 8 weeks. But even that, it's really been building for years, where you get swings, you get much quicker swings, plus or minus in the equity market in particular. And if you focus on that, you become, you don't want to focus on that because that's too short term. You just continue to focus on the longer term line. Anything else before we sign off? All right. Well, thank you. It's good as always talking to everyone and appreciate your questions. And we look forward to continuing to work with you. So we'll keep going.
Thank
Thank you
you.
very much.
Thank
Thank
you.
you. Bye-bye.
Okay, so based upon that conversation, I want to transition into the conversation about our investment policy. In our last meeting, we talked about looking at our investment policy, and then we talked about having the actuary do an actuarial study regarding the impact of some changes. Brad nicely sent me some language to send to the actuary. I communicated with the actuary and got back a quote from them to do the study, which came back at a quote of about $50,000 for them to do the study. To me, that seems really high. I reached out to Brad and to Lucy, and they talked, and Brad sent back some communication that to him that didn't seem completely out of line for asking what we were looking at. And so I'm gonna have Brad talk a little bit more about kind of the importance of doing that study. And then we are looking at having Brad, Lucy, and I maybe join a call with the Gallagher actuary to talk a little bit further in detail and make sure that we're all on the same page.
Yeah, I'll just share a couple quick thoughts. And I exchanged some emails with Blake as well, and he reminded me that our last experience with the consultant was not very positive.
Right.
Who here remembers our last consultant or whatever that guy was? Let's try to purge him from our memories a little bit. I'm not sure where he came from, what his qualifications were.
He was pushed upon us by this. The former superintendent definitely wanted us to utilize him, and that's how we got in that arrangement.
Yeah, that was weird, and I didn't like that guy. He didn't bring a lot of value to the conversation. I think my experience with actuarial consultants is that what you'd be getting with this engagement is leagues beyond what that guy delivered. So think of this as a much more professional presentation. You can trust that you've got at least a handful of credentialed actuaries providing the analysis here. So put the quality concern aside. I'm confident that if we do follow this engagement with our actuaries here, we would get quality work. Now the real question is is the information that we would hope to get from this report going to be worth that kind of spend, whether it's 50,000, 75,000, where it is. My thoughts are that it's a reasonable price for what we're asking them to do here. And so where I'm coming from is, it's been a while since we've had anybody kind of come in and do a deep liability study and figure out what is an appropriate asset portfolio for this type of plan that we have here. What's going to give the best value to the retireds? What's going to drive long-term success for our actives? I don't think we've done that in the last several years. So I think there are some important questions that they could dive in a little bit and help us to understand, what is the right asset allocation? What's the appropriate amount of risk that we can take with this plan and still feel confident that stakeholders are going to have positive outcomes, and we're not going to push too much risk onto the district. This plan is very different than it was 10, 15 years ago. The proportion of retireds to actives has increased materially. We've cut off the plan to new participants. It's just in a different phase right now. And I think we're at risk in a couple of different things here of on the retired side, taking too much risk with the benefits that they're owed. But then on the active side, are they at risk of not achieving their goals longer term, which is a big risk, I would say. So I'd like to have them come in. If the group has any thoughts, I'm happy to hear them and debate them. And I think the group we should all share our opinions on this. But my thought is that, $50,000 spend, we could easily outpace that if we get on the right investment strategy and can come in and say to the board, here is an investment strategy that we have validated externally. It's not just a couple of volunteer actuaries and some dedicated teachers. It's credentialed actuaries who are putting their credentials on the line by making these recommendations. So I'll maybe pause there, and I see we've got a question in the queue here. So Blake, do you want to say your piece?
Yeah, I think, Brad, for me, one of the pieces that I think I am not understanding is what do we anticipate being the actual information, what content will come back to us? And I'm going to ask this a little more specifically, because I think one of the things that I just heard you say that I think is important is that we're not really just looking at the asset allocation as a component of like, if it's 65-35, these are sort of the anticipated range of where dollars would go. And it sounds like what you're suggesting is that the conversation with the actuary is more about the greater objectives of within our plan, what are the goals, those long-term goals for actives, and what are some things to consider? What are those goals for the inactive actives? And, what are the, what's the right standard? And so I guess I want to make sure that what we're asking for is really from the actuary, some sense of recommendations for how dollars are used within the plan to meet the different objectives, and that we don't create such a closed mindset that what we're doing now in the exact format has to be what we're doing in the future. In other words, are we asking for a broader conversation about what can be done to still meet the needs for actives in the best way possible while not jeopardizing for retirees? What are the best ideas and solutions for the retirees that don't jeopardize where things are going for the actives? And that it's not just a look at what's 70-30, what's 65-35, and what's 60-40.
Yeah, yep. I might share my screen here, and this is going to put some text on the screen. And I apologize if anybody has a hard time reading it, and I can speak to it if anybody needs me to. Can everybody see my screen here, or the folks that are on a computer?
Yes.
Can you see my screen?
Yes.
Okay, so my intent with this, or how I would insist that we shape this proposal or this engagement with the actuaries, is to ask very specific questions oriented around plan member outcomes. So I put together a handful of questions here. So just to read off some key points here, asking specifically the question, and the demand is going to be that we get answers to these questions. Does a higher allocation to equities improve expected retirement outcomes for active members? So trying to address the active member concern there. I've also pointed out a couple different times the excess earnings mechanism can harvest some of those higher returns. And so what you actually end up seeing is the retired members can be subsidized by those excess returns. And the active members kind of have to see returns way above and beyond kind of what the norm is before their long-term outcomes can improve. So there's sort of like the traditional relationship between risk and return is the more risk you take, the more returns that you get. That balance for the active members is a little bit different than what you see in the general public. And so I really want to understand, are we asking the active to take on too much risk in this long term, knowing that a big chunk of their upside is going to be siphoned off by the excess earnings mechanism. So I really want to understand for actives, how much could more equities benefit them, articulate that, and then talk about, how much is this excess earnings mechanism holding back the active members? The next question I had was, does an increased allocation to equities increase shortfall risk for the plan, given that the state that we're in right now is that we have significantly more outflows from the plan than we do inflows? I think we heard from BTC earlier, if you're a very young member just starting your retirement savings journey, you can plan for a lot of market volatility because you have a lot more inflows into your account than you do outflows for the next several years. And so you can afford to take on more risk. As you get to be a retired member, the outflows increase. And so your tolerance for risk is going to decrease as well. And so thinking about this from a retired member's perspective, do we have shortfall risk in the short term and the medium term? What does that do to the district's obligations? And, just thinking like in a tail scenario, I mean, we're coming up against some market volatility right now. We could easily imagine, I think, where things get out of hand, equities fall and they don't recover fully for several years. What sort of a outcome does that produce for the retired members, active members, and the plan as a whole? And then just kind of specifically putting the question to them, does the potential reward of increasing equities outweigh the risk to the plan as a whole, and then separately for active membered and retired members? So I'm trying to embed some like concepts that I want questions or answers to, but also really focus my questions on how would a change in strategy affect outcomes for our plan members, both to the upside and to the risky downside. So I've been talking for a while and I've been looking at this email and not looking at faces. Did I lose anybody, or does anybody have any questions, or is this helpful context for you guys?
The context is helpful. Certainly the last time we went to an advisor, an actuarial advisor, we had some very specific questions too that we wanted answered. And we didn't really get anything out of it. I mean, we spent the money, we spent the time, we asked the questions, we spent a lot of time putting together good questions. And what we got out was a whole lot of mumbly muck. It really didn't give us any direction or purpose, and it wasn't really clarifying. I hear
Which
you
analysis was
saying
that,
that,
Jessica?
I hear you saying that it won't happen this time, that's unusual. I hope so. We're gonna invest the money. I would like to make sure that we get some return on that, but
Are you referring to the guy that the superintendent kind of pushed on us?
Yep.
I'm not sure if was he an actuary, Kathy, or was he just some guy?
I'm really not sure of his qualifications. I think he was kind of just some guy who played in the investment space. And I'm not sure, but I think we all can agree that we didn't get what we thought. And his assumptions that he used, none of us were comfortable with. And I'm hoping that with Brad and Lucy on our team here to talk actuary to actuary, they can talk a little bit more meaningful and we can get back something that is a usable product.
We spent weeks, months coming up with our questions and really hammering those out so that we could put him in a good spot. And then we spent a lot of time just trying to get him to understand what it is, how our plan even works. And when he came back, he obviously didn't have a good understanding about how the plan even worked. And so when we were done, it was really distressing.
It was frustrating, I think, for all. We'll put that one behind us and move forward and hopefully get a much better result.
If we want to do this, I guess. Blake, go ahead.
Yeah, I mean, I think for me that the challenge question, and Jessica is really alluding to it, is I know our actuaries have at least probably a rudimentary understanding of the structure of our plan, whereas our Texas Yahoo team did not, and they never really took an interest in understanding, our specific plan. But I think that, the element of understanding the impact on excess earnings, I think from the perspective of for current retirees, But I think also we need to add the dimension of the question of for people who are going to be active, because there are some unique pieces here where, you know, a retiree has a guaranteed interest rate earnings regardless of the, you know, the conditions of the growth. An active member does not have that same guarantee. A retiree has the guarantee of the excess earnings when the plan exceeds, you know, being able to earn the 4.5 or 5% for across all of those groups. And so I'm not exactly sure how those questions need to be asked, but I think that there's the components of let's understand all of that dimension, the guaranteed rate, the excess earnings from an effect for retirees, but also for the actives, and understanding, you know, the conditions. And so that we're not really talking about an investment policy discussion. We're actually talking about the mechanism of when a dollar goes into this plan and a dollar comes out of this plan, um, what are the best strategies? And I guess my question is the actuary the team to provide those kinds of recommendations? Is that the appropriate angle? And is that the right experts to be reaching out to?
Yeah. Hey, Kathy, you mentioned hopping on a call with these actuaries and me and Lucy. I'm wondering if it'd be helpful to pull in more members of this group. And maybe even during that call, we could kind of put our problem statement, like share a screen, put it on a Word document, and then just sort of like edit it live as a group to hear, you know, Blake's concerns, Jessica's concern, the retired members' concerns as well. Make sure we're kind of asking the right questions there, and then have the actuaries on the line sort of react to that and say like, yes, we're comfortable, we can do that, and here's what you're going to see, just to kind of allow them to kind of make a pitch here, because I know they're actuaries, but they are in a sales job here, and so they should be able to kind of hear the client concerns directly and be able to tell us, you know, yes, we can do that, or yeah, but it's going to look like this more, or here's some caveats. I think it'd be beneficial for this group to hear it directly from the actuaries, just to kind of develop some
Yeah.
credibility with them.
Okay, I think that's a good idea.
Me
I
too.
can try to get something set up for after spring break, maybe like the first part of April. Jessica, you ready for spring break there? I can try to
Can
get
we
a
also put in
meeting.
the minutes that the previous consultant will be formally and forever referred to as the Texas Yahoo?
Yeah, I really liked that, Blake.
Perfect.
Wasn't that his name? I thought that was his name.
You know, I don't even remember his name. I blocked it out. That's terrible, but I don't.
I just remember he was insisting on these crazy capital markets returns, and I was like,
Yeah.
man, why are you assuming this? Like,
Yeah.
15% equity returns forever, and it's like, man,
I'm still waiting
have some
for my
perspective.
12%.
Yeah.
It was crazy. It was crazy.
Yeah.
Well, and I think he was assuming, you know, we were 100% equities too. I mean, yeah, we could
Oh.
have a year with really good equity returns, but our portfolio isn't 100% equity. So I don't know. He was different. But let me set something up for April. I'll reach out to the actuaries and see if they're amenable to that, and then we can set up a meeting and do a Teams call and do just what Brad walked through, because I think that would be really good to have everybody in that way. The actuary really understands what our ask is. And then they can respond, yes, we can do it, or no, you know, that's not something we're comfortable even doing. And I think if Larry, our normal actuary, was talking about having another whole team on board for this, which I think would be beneficial for us as well. I don't think that having just Larry do this is going to give us what we want.
Yeah, I think this sounds like a good idea, because like if you were going to ask me to sort of call the question on this item today, I probably would be a no vote, because I don't have any confidence. I don't really know what we're getting back as a result to know. I think in my mind, I think I'm being a little too small with my thinking. And I appreciate, Brad, that what you're saying is what we're asking for is something much bigger, broader, that can actually give us short-term and long-term objectives and standards and sort of goals for all of us, and that the school board can then see, so that they also have something to measure, like how are we doing? Because I think right now we don't really have that. we just constantly go into, oh, we're 92% funded. And I would argue that the funding status is, I'm not saying it's not important, but it is one of what I would say 5 factors, and we don't ever report the other 4, which is how are active members doing? Like, what track are we getting them on? How are retired members doing? What are they actually, what's their paycheck actually looking like? What's their excess earnings? And when we don't ever report any of that, you know, the report kind of comes back and you go, well, it seems like DMTRS is ho-hum. And in reality, we've made really good progress the last 2 or 3 years, but we're still 5 leaps behind where we need to be.
Yeah. I'd also be interested, just to kind of like put the whole scope of options out there. If they could do a comparison maybe around like the contribution rates that actives make today and what the district kicks in today. What would it look like if we completely froze DMTRS to all new contributions and directed all of your contributions to traditional 401k plan or that type of plan, right? And potentially for the retirees thinking about like moving to like a risk transfer situation to kind of put the plan up to bid to have it be managed by an insurance company instead of you know, having this group and a plan actuary run it through. BTC is great, but they're not necessarily like insurance investors. And so I'd be curious just to kind of get kind of their input on kind of the whole perspective of like, should we tweak the plan? Should we radically modify the plan? Should we freeze the plan and have it operate kind of on a more modern model potentially? And kind of say, what would that do for participant outcomes? Because there is a possibility here that active members today are being held back a little bit by sort of being attached to a large retired block that has the excess earnings mechanism driving things. So I just want to make sure we're exploring all the outcomes and everyone's kind of wide open on what different possibilities are. Speaking of excess earnings, are there more items on the agenda?
Nope.
Okay. I know Lucy did some looking into, and I don't see like Jim on the call here unless he's hiding under somebody else's name, which wouldn't put it past him.
Yeah, he wasn't able to get on.
Okay. Lucy did some really good digging into the spreadsheet that was provided that kind of like explains excess earnings a little bit. And maybe in the interest of time, Lucy, if you want to share your screen maybe and go to that last slide that you have that kind of shows how excess earnings varies by different returns. And maybe just kind of talk about your findings a little bit and kind of a brief way. And if we need to follow up with retired members to walk through this a little bit more, I think we're happy to do so.
Yeah, absolutely. So I prepared kind of a look on the different excess earning percent increases that the retiree block would see based on the various total return for the plan. And obviously, I know you all know the different groups have different trigger points where essentially once you hit your trigger, then you start participating the upside above that trigger. So group 4 is the one that has the lowest trigger, so they start participating earlier. And you'll notice that until 5%, they have all the upside of that excess return, right? And then group 2 kicks in and group 3 kicks in. So only as you kind of get out to, you know, the higher return scenarios do the groups 3 and 4 really start participating in that upside. So I know that Jim was kind of questioning, I'm not really seeing a big change in my percent increase year over year. And that's because a lot of the return that the plan has seen over the past several years kind of hovered between the 5.5% to 6%. And you'll notice that that doesn't really have a lot of fluctuation, but there is quite a bit of fluctuation between that range for groups 3 and 4. So that's kind of why kind of some of those results that we're seeing are the reason, are the way they are, I mean. Some pause. Does that provoke any questions?
Yes.
ahead.
I just looking back over mine, and I think Jim's question was never before, have excess earnings stayed the exact same amount. Like the last 3 years, they have all been 13% for our group. Even though, the net investment performance varied each of those years. And, and I go back to 21, it was 9%, and then 2020, it was 11%. So I guess just in terms of
Mhm.
how they're being calculated, has that changed? It just seems odd that they're exact same amount. And I know that
Yeah.
was Jim's concern.
Yeah, that's a great question. And part of the reason for that is that there's a payment cap. Basically, limits the amount of upside that can be distributed to retirees. So that upside is capped at 10% of the liability of the plan members. So you'll never see kind of a benefit that averages more than 10% for the entire group.
Okay.
So that's kind of why that you're not seeing like such a massive distribution. Like for example, I think last year might have been around 1.5 million was the cap. So there's not going to be any more additional income presented to the retirees higher than that. And so basically, no matter how high you get, if you had a 15% return, you really wouldn't see anything higher than a 10% average increase for the retirees. Does that help? So it's the goal with that is essentially to make sure the plan can stay healthy, because if we just allowed unlimited upside, then there would be no growth essentially in the plan above 4.5%. Does that help?
So Lucy, some of that cap, I think was put into place too to protect the actives.
Correct.
Right.
Although it doesn't increase their percentage that they're getting on their investment, it still protects the plan assets for them more.
Correct. Yep. So the goal again is to kind of allow the retirees to participate in some of the upside, but then still maintain the earnings growth of the plan so that the actives can still have a healthy plan.
So are you saying that, and I thought it was cap, and I appreciate these this information. I hope we can have access to it
Mm-hmm.
to refer to in the future. So if, let's say, it really is 16 or, 17, 18, 19%, but nothing above the cap
Yep.
will go out to the retirees.
Yep.
So the excess of the excess goes back into the plan. Is that what you're saying?
Correct. Yep. So that just goes back into the plan assets.
That's okay. That's what I
Yep.
thought I was understanding.
Mm-hmm.
Which overall helps the funding of the plan.
Right.
Correct.
And then
So
there's also a 3-year averaging. Is that correct?
Yep, that's right. So kind of the drivers of the excess earnings are, first of all, the retiree group you're in, the smooth investment
Right.
return, which is that 3%, and then the payment cap. So this kind of dictates the pattern of your increase that you see each year.
Okay, so if there is more than, we get 13%, it's really 15%. Does those extra 2%, do they go into the next averaging for excess in case the earnings are less?
Well, that extra, like kind of, if you're up in that 15% range, it doesn't really help anyone too much because you've already hit that 10% cap essentially.
I
So it would,
understand that. But that excess of that, is that
Yep.
going to be figured out in the 3 years?
I'm not sure if I'm understanding the question.
So are
I
you
would-
saying, Lola, like if 1 year we had 15%, 1 year we had 5, and the next 2 years we had 5%?
Yep.
Is the 15 going to be used or is it going to be capped at 10? Is that what you're
Oh.
asking,
Right, I'm wondering
Yeah.
thinking?
if we would benefit in the future when it's low, that it would help make it a little bit more bearable with excess. Or is it, once it's back in the plan, it's in the plan and not available to us for excess?
No, so that 15% would be contributing to the 3-year average. So that wouldn't limit like kind of the upside, if that makes sense.
That's what I was thinking happened, but I
Mhm.
appreciate hearing it.
Yes.
Can I ask a question? If we hit, let's say we had 4 great years in a row,
Hmm.
is it just a continuation of those funds that the dollars that did not get allocated to members, would it just be a carryover amount that would sit in the plan? So in a sense, eventually it always would catch up, unless if for the next 55 years we had positive returns that exceeded 1.5 million.
I think it depends on the liability amount of the actives and retired. So I don't think it's as much driven by the plan assets as it is the liability. So that's like kind of the actual valuation of the amount that needs to be paid out. So that would dictate the cap.
Yeah, that makes sense. Thank you.
Okay, thank you. But can we have a PDF file or something of this information that you are
Mhm.
sharing with us?
Yes, absolutely. So yeah, I'll send out a PDF to Kathy, and she can distribute to this group. But yeah, I just wanted to kind of just break down the drivers. I didn't get a chance to kind of go through in as much detail just because we ran out of time. But
Great.
yeah, I think this will be helpful for everybody.
I've had some
Great, thanks, Lucy.
Of
class.
course.
Lucy, thank you for that. I think that was really helpful. I appreciate
Yes.
you digging into that.
Of course.
Anybody have any further questions?
No, but
So Kathy, I just want to make sure we're waiting for you to kind of confirm, a possible date and time to meet with the Gallagher team.
Yes.
Thank you.
And I would like to hear Lucy's report sometime. So I appreciate being able to read it. That's helpful. But if she wants to come back, we put her at the top of the agenda so we can actually hear all the details that she wants to add. That'd be
Mhm.
valuable to me. I'd love to know that.
Sure, I'd be glad to.
Perfect. Thank you so much. In the interest of time, we are over time, so I will let everyone go out and enjoy what's left of the day. And I will get back to you as soon as I get dates.
Thank you
Can
so much.
confirm the
Thanks,
next,
everybody.
the next meeting?
Enjoy.
The next meeting we should have on this calendar already, and I can't remember Rosie off the top of my head.
Okay.
Where's Blake? Blake already logged off. He's my one that keeps me honest. I will send it to you when I look up when I get the next one for the actuary. I'll also send you the
Okay.
next meeting date.
Okay, just want to make sure.
Okay.
I have May 14th tentatively, but I
that
want to make
sounds
sure it's
right.
right.
I have May
Yep.
14th.
Okay,
Okay.
just want to make sure.
Sounds right.
Thank you.
Okay. Thank you.
Thanks.
Bye-bye.
Bye.
Okay.